Could we be on the path towards another nationwide housing crisis? Right now, there are signs in our economy that might be pointing to yes. Despite what you hear about our strong housing market, the shortage of homes, and how real estate is always a good investment, there are warning signs of another housing crisis just beginning. In an interview with Adam Taggart on his YouTube channel, Thoughtful Money, housing analyst Melody Wright revealed how shocked she is by the latest stats that show how quickly the housing market is starting to deteriorate. In case you didn't know, we're experiencing record low transactions during what's normally the busiest time of the year for home sales. Inventory is up year over year, and what stands out even more are the spiking delinquencies. Despite being in the peak season for home sales, transactions are at record lows. Higher interest rates and cautious buyers and sellers are likely to blame. Nationwide, inventory has surged by over 30% compared to last year, which is a huge increase. Adam points out the spike in delinquencies is very concerning, with rates in some areas even surpassing those during the 2008 global financial crisis. This combination of low sales, high inventory, and rising delinquencies paints a troubling picture of where the housing market might be headed. In Melody's words, this is the turning point and winter is coming for the housing market. However, you wouldn't know it by looking at the median existing home price, which just hit another all-time high. So with cracks forming, is the country sleepwalking into another housing crisis? Real estate warning sign number 1, unaffordability. We all know that housing prices are really expensive right now, more expensive than they've ever been. Last month, the median home price was $434,000. At a 6.5% interest rate, you need approximately $2,700 per month after taxes. That's not including property taxes, insurance, utilities, or maintenance. With all that, let's say it's another $1,300, which brings the monthly total cost you'd need to around $4,000 per month. This is how much you'd need to pay each month in order to afford a median priced home in America right now. So doing some quick math with the help of ChatGPT, we can see that you'd need approximately $5,714 in pre-tax earnings per month to cover a $4,000 monthly mortgage payment. And that's assuming you're in the 30% tax rate. And this is just to cover strictly 100% of the monthly mortgage payment. Times 12, that's $68,568 of gross. That's pre-tax earnings you would need to make. Now keep in mind, that's just the mortgage payment. I haven't factored in anything else you'd need to earn to cover things like living expenses, food, clothing, entertainment, health insurance, or even car payments. Real estate warning sign number 2, rising property taxes. This $4,000 monthly payment to afford a median priced home is a moving target, and that's because of property taxes. Housing prices have gone up, and now so have property taxes as well. They're usually delayed a year, but they eventually adjust higher a year or so later. So if your property values went up by 50%, then you can expect a big jump in your property tax bill. Check this out.
If you look at this,
Cook County Treasurer Maria Pappas says many people will be shocked when they see their latest property tax bills.
I'm sitting in my house, I have fewer groceries, and now I get hit with this bill, which is bigger than I've ever seen in my lifetime.
Homeowners hit hardest, according to the treasurer. Park Forest's median residential tax bill shot up 56%. The largest residential increase by percentage was in Dixmoor, with a 122% increase.
Did you know that if you don't pay your property taxes, the taxing authority can sell your home for the unpaid taxes? These are called tax sales or tax foreclosures, and they are currently increasing. Real estate warning sign number 3, rising delinquencies. In this interview clip with housing analyst Melody Wright, she talks about the significant concerns she has for delinquencies.
I used to manage default back during the crisis. When I saw these results, we saw over 19% increase in month over month in 30 plus delinquencies. You don't make that decision lightly to go 30 days late on your mortgage. This is how banks think. I'm just going to tell you right now. They love it when you're late because they can charge you that late fee. Going 15 days delinquent is just fine. Going 31 starts an entire different costly process they don't want you to do. To make that decision, it's not one taken lightly.
Real estate warning sign number 4, rising inventory. In this next clip, Adam highlights that housing inventory is up 23.4%. It's an increase year over year. But Melody has data that suggests this figure is even higher.
The stat that I've seen in the media is that inventory nationally is up 23.4% year over year. But I believe when we talked yesterday, you said you've got some other data you've looked at that suggests it could be even higher.
Yeah, the Fred data which they get from Realtor.com, that's at 29%. When looking at just new listings, I've seen a stat for over 35%. So it's going up all over the country. The Florida season really ends in April. And so for them to be growing inventory at all is really atypical behavior. But we're seeing it all over the country, not just in Florida and Texas.
Are you seeing inventory rising in your area? Let me know in the comments. Real estate warning sign number 5. Prices have peaked and sellers are motivated. In this clip, Melody points out that prices peaked in 2022, and she's seeing that sellers are also highly motivated. Many argue that housing prices won't come down, and that's because they say there's a housing shortage, they say we don't have enough homes, and we haven't built enough houses to keep up with demand. Let's hear what Melody has to say about this.
We saw the housing market peak in 2022. Pricing data, I think median home price can be very misleading during these turnings or inflection points, but that was the peak. And we have been turning in housing since then, and it moves at such a glacial speed. We have just, in my opinion, of that turning, reached the inflection point where it's happening all over the country, not just in Florida, in Texas. People are waking up and becoming motivated sellers. They just got their escrow notice that told them their insurance and taxes have gone up and now their payment is $600, $700, just double. I've even seen triple of what they're going to have to pay. And at the same time, the builders, they bought the inventory myth hook, line, and sinker, but the local regional builders, if there was land, they went and built one of these subdivisions, or they really participated in the fix and flip market. I don't think this is isolated to those Sunbelt states. I think that there is enough of the speculation all over the country that the whole country is going to be impacted.
Real estate warning sign number 6, how layoffs will affect housing. Later in the interview, Adam from Thoughtful Money brings up a great point. So for existing homeowners who may be sitting on a 4% mortgage, everything isn't perfect and rosy for them. No, they're feeling the pinch as well, and that's due to inflation. Higher costs on things like insurance, repairs, utilities, maintenance, property taxes as mentioned earlier. The question is,
what happens to all of this if we start having layoffs at scale?
Yeah, it's just going to get worse. Back during the GFC, what really started was the non-traditional products, the investor loans, the subprime, and then your prime borrowers got into trouble, right? I don't need to see further job losses. If we just stay on this path and nothing else changes, you're going to get to delinquency because people simply can't afford the house they have based on these increases in prices. But if we get layoffs, it's going to make it even worse.
I'm not saying the market is going to crash by any means, but I think I've highlighted some big cracks forming in the housing market. There's clearly a lot of uncertainty in this market.